Hello everyone, Troy Eckard here with Eckard Enterprises. Today we're dealing with something that we haven't seen in over 40 years. We're dealing with raging inflation. Right now it's September of 2023. We had inflation heavy in the first quarter of this year. Seemed like there was a cooling off. And then we watched commodity prices, we watched the cost of debt, we watched interest rate, we watched liquidity. We watched virtually every component of the economy start to vacillate and change how it responded to what we saw as a monetary shift from being a low interest rate environment to a high interest rate environment, from a oversupply to an undersupply to a no inflation or minimal inflation to now what I would consider to be on the verge of raging inflation coming in the next 24 months. So the pending question is, how does oil work in correlation with potentially the rising or falling inflation? Well, let's just make it very simple. Oil's bought in dollars. Dollars are going to be driven higher or lower by the perception of the value of that dollar. Typically, when the dollar goes higher, oil goes lower, right? I can buy more oil because my dollar's worth more, so it makes oil cheaper. The reverse happens when the dollar goes down. I have less value in my dollar, I can buy less barrels, so it makes the price of oil go up. The reality of it today is we have something I haven't seen in 40 years. We have the dollar been going up, and so is the price of the barrel of oil. We also see the stock market going up. None of the three are acting in correlation together. So let's forget the dollar for a second. Let's forget the stock market for a second. Let's talk fundamentally about where we're at when it comes to inflation. Right now, we're seeing inflation truly start to mark its ugly head of what it has been doing the last 12 months, but has been suppressed by manipulation of the definition of a recession and the definition of inflation. We are truly in a recession. Things have been receding, okay? The recession is caused by the fact the economy is not growing. Now, we've had certain sectors grow, but as a whole, the economy has been languishing for the last 12 to 18 months. We've also been dealing with hyperinflation. Now, the Feds would like us to believe, don't worry, inflation has been going down from 8.6 down to 7.9 down to 6.7. But that's if you don't include food and clothing and oil and automobiles and toothbrushes and shoes. In other words, if you don't count anything, we have no inflation. But the consumer knows better. The consumer's going to that grocery store, and they used to fill up a cart for $300 worth of groceries. Now the cart's coming out a third full, and the bill's higher than what it was when the cart was full 18 months ago. When they fill up that car, gasoline price and diesel are going up. When they look at their rent, it's going up. We look at labor costs, is going up. So everything fundamentally is going higher. And that's been with an artificially suppressed oil price, because between the U.S. government and their policies, what they did was they released 245 million barrels of oil out of the strategic petroleum reserves, and that artificially put more supply in the market. That's not true. We're not producing it. We took out of our savings account and dumped it in the market. Today, oil's at about $91 to $92 a barrel. It's moved 42% higher in the last 8 weeks. Natural gas has been suppressed because of weather and an overloading of supplies in 2022 because of the Russia-Ukraine war. Everybody loaded up with liquefied natural gas. How oil works with inflation is as follows. You can have inflation driven by other factors like overstimulating the economy with massive liquidity, which was the stimulus packages thrown out after COVID. That created raging inflation. Oil prices were down here at $55, $60 a barrel. But because of that raging liquidity, everybody started buying boats and cars and houses and spent all that liquidity, which drove the manufacturing sector, which drove the demand, which drove more consumption of petroleum products, which means we started seeing higher oil prices because we weren't producing enough. Today, it's a little bit different. Today, we have oil prices that are really driving inflation, and they just kicked in about 8 weeks ago. Why is that? Everything from the watch I wear, the shirt I have on, the hairspray in my hair, the pad, the pen, this entire room is made from a barrel of oil. So if we still have this raging demand, right, and we have rising cost, part of that rising cost and demand has never been really affected the last 12 months by oil prices because they were down to $63 a barrel. Now, because of record demand for oil, supply that's been languishing and leveled off with the ceiling is not going to be able to keep up. We're going to be 2 to 3 million barrels, if not more, a day short of oil in supply versus the current demand. What that tells me is Now we're going to see oil drive inflation, and as oil goes from $63 a barrel 8 weeks ago to $92 a barrel today, 42% increase. The syringes, the gloves, the dishwasher soap, the fertilizer used, the food for your garden, the gasoline in your lawnmower, every single thing that has any aspect of a petroleum byproduct being used in it is going to escalate artificially 40, 45, 50% in value, and I don't think we're going to stop. I think oil's headed to $125 to $150 a barrel. So how is oil correlated with inflation? It's either a victim of inflation, which it was 3 years ago. It got driven by over excess liquidity and demand. Now what's driving it is lack of supply, record demand, and quite frankly, there's no capital in the market. So there's no capital for investments to go into fossil fuels to increase the supply, so we're in a panic point. Today, inflation will be driven by oil and energy costs, and we're talking a long run. This is not a 6-month, 12-month, 18-month. We would have to ramp up oil and gas in this country. It would take us 2 to 5 years to even remotely put a dent in adding enough supply to offset the demand, or they've got to completely stranglehold the economy. I mean, kill it with rising interest rates like they did in the 1970s, which means that's going to take at least 6 to 12 quarters of continual raises in the Fed rate to finally choke off the demand, which then allows oil to stop being in such demand, maybe prices will suppress. But I got news for you. We're in a whole new range. Oil was at $25 to $35 a barrel in the 80s to the 90s. Then oil moved up to about $35 to $55 a barrel in the late 90s, early 2000s. Then after the 2008 debacle, oil prices moved from basically $55 to $75 a barrel. In today's market, what I see changing, we're about 3 years away, we now will be in a new range, which will be more like $90 to $125 a barrel. It's because of inflation, the cost of exploration, the cost of goods, the cost of labor. In other words, for anybody to drill the amount of wells necessary to give us the supply, they're going to need $90 to $125 a barrel to justify doing so. We're in a brand new regime. If you factor that into the economy, not only today are you going to see raging inflation as a result of higher energy prices, but that is going to be an underlying factor going forward for the next 10 to 20 years as oil prices continue to move up that ladder, charging more and more per barrel, which resonates right down to that absolutely, the little pencil you're writing at home, to the TV you're watching, to that shirt you just pull over the top of your head. Oil and gas is going to drive inflation for the next 3 to 5 years. For us as mineral owners, working interest owners, we're going to win big time. We may lose in some other assets, we may lose in some other investments. We as a general American population are going to take the brunt of this inflation. I really believe it's it's rampaging, rampant stagflation with super high inflation rate, okay, followed by virtually no growth as the economy begins to languish. Oil and gas is the right place to be, folks. We're riding the same direction as the winning car. Congratulations. Troy Eckard with Eckard Enterprises, signing off.